Good day, fellow investors. We continue with our investment hints, and in this video I want to discuss taxes and a simple solution to investing and taxes, because it's very common that I get a video, yes Sven, but here we pay 25% dividend tax, here we paid 45% capital gain tax, here we paid this tax, here we paid that tax. Especially Italians are so focused on taxes that they miss completely the woods out of the trees. And therefore, I really want to give you here a simple tax solution when it comes to investing, and what I apply, and will use also a lot of Charlie Munger. So for example, this stock that we discussed, yes, if we pay a 25% dividend tax on this, the dividend yield is not 6.54%, the dividend yield is 4.9%, 75% of the nominal dividend yield. And that's it. So whatever happens, the simple tax solution is implement the taxation in your calculation, investment calculation, and then see how it compares with other investment opportunities. So if your capital gain is 45%, implement that into how much will the reward, what will be the expected yearly reward to your investment opportunity. Then you compare. It is as simple as that. And to add a little bit more on taxes, here is Charlie Munger. In terms of business mistakes that I've seen over a long time, I would say that trying to minimize taxes too much is one of the great standard causes of really dumb mistakes. What Charlie here discusses is when you go into extremes of minimizing taxes, tax shelters, Panama Papers, whatever. Because, of course, legally you can try to minimize, you can change accounts, you can have pension, retirement, deferred taxes accounts that we'll discuss in a second. But people being overly motivated by tax considerations make terrible mistakes, as Charlie Munger says. Warren and I personally don't drill oil wells. We pay our taxes, and we've done pretty well so far. Anytime somebody offers you a tax shelter from here on in life, my advice would be don't buy it. Continuing on that story, I talked to one accountant, a very nice fellow who I would have been glad to have his family marry into mine. He said, what these other accounting firms have done is very unethical. The tax avoidance scheme works best if it's not found out by the IRS. So we only give it to our best clients, not the rest. So it's unlikely to be discovered. So my firm is better than the others. He's not kidding, and he was a perfectly nice man. People just follow the crowd. Their mind just drifts off in a ghastly way. And this is where I live in Croatia, and this is the marina there. This is a summer picture, and you can see hundreds of boats just docked here. I don't know who was the tax advisor there, but these boats never ever go out. Mostly Austrians and Italians, Germans, but just a few people that like going to sea are left here, but over the summer those boats never go out. So that's clearly some kind of tax scheme, buying a boat and things like that. But I don't think anyone except the advisor made any money on that. It would be better to just have a simpler life without these crazy tax shenanigans. As Charlie Munger says, we don't have any miraculous way of avoiding taxes at Wesco and Berkshire. And this is something very important. If you're going to buy something which compounds for 30 years, again, always apply the current investment situation to your tax situation. At 15% per annum, and you pay once 35% taxes at the very end, deferred taxes in a retirement account or something like that, the way that works out is that after taxes you keep 13.3% per annum. In contrast, if you bought the same investment but had to pay taxes every year of 35% out of the 15% you earned, then your return would be 15% minus 35% of the 15%, or only 9.75%. per year compounded. So the difference there is over 3.5%, and what 3.5% does to the numbers over long holding periods like 30 years is truly eye-opening. So depending on the tax limitations you have in your country, how much you can put where, it is very important also to understand the nature of your investment and into what account to put it. And to conclude on taxes, you know your taxes, pay those, compare everything, all the opportunities after taxes, holding periods, and whatever, and then just see what is the best investment. It is better to pay 25% dividend tax on a 10% dividend yield, good long-term investment, than somewhere going for 5% yearly capital gains just not to pay taxes. And I see a lot of confusion there because people are allergic to paying taxes when it comes to investing, but just pay them and go forward with your life. Focus on the value, not on the taxes. Avoid tax schemes, real estate boats, tax shelters. Most likely, only your advisor will gain a lot from that. All you get is worry. I also know a lot of people that tried to save in any other way possible, buying real estate, whatever, but that never amounted to great returns. Pay taxes, focus on finding great businesses that will deliver great returns at a fair price, and that's all I have to say about taxes. Thanks for watching. I'll see you in the next video.